All right, so thank you everyone for joining us today. AIC, we are very proud to have with us today Dr. Robert J. Frey, and he's a businessman, he's a mathematician, and of course, a quant. So without further ado, let's ask Dr. Frey. So can you spend a few minutes giving us a brief outline of yourself, your career, your background, and the history of FQS Partners?
Sure. Well, I was working in this is many years ago in the 80s. Actually, I was working in the defense industry, and you know, uh, I I was approached by some people who knew my dissertation advisor, and they people working in Wall Street. And I'm saying, what would somebody I was working in defense, which is electrical engineering and operations analysis and all this sort of stuff. I said, why would somebody in Wall Street be interested in me? I don't know. And it was a group from Morgan Stanley that was doing pairs trading. The first, kind of the really, I think, the first major what you might think of as high frequency finance, high frequency trading operation. And they went there and they basically were, they had this system they had worked out, and they felt they needed like more mathematical muscle to go to that. Well, I started there, and I found that first I said no, but they kept offering me more money, so eventually I went. So I worked there for a few years, and then that there was some political difficulties at Morgan Stanley, and I thought it was time to move on. And I knew Jim Simons, who's quite famous, obviously, in the field. And you know, I left with somebody else from Morgan Stanley, and with Jim, we started up a firm called Kepler Financial Management. And we were doing not pairs trading. I had sort of thought, one of these things that occurred to a lot of people, not just me, was that pairs trading could be done more effectively if you sort of used something like a factor model to hedge out your systematic risk. And then what you did is you traded patterns in the error of the factor model. That's what you were sort of looking at. And essentially that's what you're doing with a pair. You go long one guy and short the other. You're sort of using that to hedge out the systematic stuff, and you trade the difference between those two, essentially. So that was going okay. But Jim also had Renaissance, and Renaissance was doing mainly the kind of CTA type stuff. It was trading futures on things like bonds and pork bellies and orange juice and all, and a foreign exchange and that sort of thing. So Jim said, I have these things that are going on in Renaissance. That's that we know, and I see stuff going on in here that we know over here. And you know what? If I put everybody together, I think the cross fertilization would be very productive, because he didn't feel like he could sort of say, "Oh, we're doing this over here," and bring it over, because it wouldn't really be fair. So now Renaissance at that time was somewhat bigger. So essentially, Renaissance bought Kepler, and that's how I got to work at Renaissance Technologies. And so so that was kind of early '90s. And I stayed at Renaissance about actually probably closer to 90. I stayed there about 14 years, and at one point I felt it was time to go. I had a good run there. I enjoyed what I was doing. I had a feeling that Jim was kind of sort of losing kind of interest, and I figured, well, maybe I've been here for a long time, and I wanted to just sort of to have a different type of life. And I was approached by the University of Chicago, who offered me a job as a professor in their financial math program. But I was also approached by Stony Brook in the applied math department. And what they wanted to do is set up a quantitative finance track within the applied math department. So that seemed to me, first of all, I'm a graduate of Stony Brook, so I had a sort of a desire to sort of kind of go back there. I didn't want to move to Chicago, so the reason Chicago knew about me is that I headed up the advisory group that sort of looked over their financial math program. So I came to Stony Brook, and that was in early 2000s, and I've been there ever since. And I started out as the director. We built up the program. As of last year, I'm no longer the director. I finally stopped doing that, but I'm still a professor at Stony Brook, and so I'm a full-time professor there. But I also, because as the money I didn't pull out, when I pulled out of Renaissance, the money didn't come all at once. But as it came in, I needed to do something, so I started up a family office, and part of that family office is FQS, which is the sort of the arm of the family office that does hedge fund investing. And other people can, if someone else wants to give money to that, it's organized so that other people can come on and give money to that. But the primary purpose of it is to manage my own, with the family's money, right? So that's where that's what I've been doing since then. And so I've continued to do research, both academic and as well as research internally for my own use, for to help me invest more effectively. And it's been an interesting time. And I mean, it's if you had asked me when I first went into mathematics, applied math, that I'd end up doing finance, I would never have predicted it, because at the time, quants didn't exist. And it's kind of odd for me to sit back now and sort of think that there's very few people who've been, quote, a financial quant as long as I have, because as I said, when I started doing this in the 80s, what Morgan Stanley was doing was quite unique. This kind of algorithmically driven trading, high frequency trading. It just wasn't something. It just wasn't done by. The only other person I knew who did it was Ed Thorpe out in California. So that was so it's been an interesting ride. I've had a great career. I've enjoyed myself. I've been able to transition through a lot of different things, and and I'm still here, and I'm still working. I have no desire to retire, but it's kind of, I kind of enjoy being a professor, and but I also enjoy staying in business as well, having a hand in that as well. So that's where I'm at now.
Well, thank you so much for the comprehensive introduction. So we definitely have a lot of questions, and we really want to go in depth into each chapter of your life, your experience in academia, your time at Rentec and now FQS, and maybe even something about your Twitter handle. But for those who are tuning in, Dr. Frey has kindly made a presentation specially for us regarding his research on market drawdowns. So Dr. Frey, would you like to share your screen and take it away?
Yep, absolutely. Okay, great. All right. Okay, so all right, so well, thank you everybody for coming. And what I want to talk about is market drawdowns. And I'm going to define drawdowns in a little bit unusual manner, but I'll talk about that later on. And what I did is I went back, almost 2 centuries looking at this, and because we have fairly decent stock market data going back about that far, and especially in, like, say, the U.S. or England and that sort of thing. We have a lot of data. But these results hold up for other markets in other areas. But I think the U.S. market is the one I'm going to focus on now, because right now it's the largest stock market, and it's one where we do have these data. So let me talk about an investment drawdown behavior is an important element of its behavior. Now I'm defining drawdown in a particular way, and what I want to do is I sort of looked at it as a you're in a drawdown if you're in a state of regret. And by that I mean is that I'm saying is if you're a long-term investor, if you're making money sort of every period, you're always at a high, But if you go through a period of drawdown, you lose money, right? Well, what happens is that you sort of look back and you say, gee, if I have less money now than I did 6 months ago, or 2 years ago, or 5 years ago. And so what I measure as a drawdown is the time from you've hit the last market, your last market peak, until you've made back that money, right? So that's a drawdown interval, right? So even though you might have a period, on the rise up that looks very good, in contrast, if you look at it against the fact that you've lost money as a long-term investor, well, you still feel like, okay, well, I'm still behind where I was. So that whole period is a drawdown period. Now, the depth of the drawdown period is the lowest point that you hit during that interval. And the length of the drawdown period is from the one former high point until you recovered what you've lost, right? So what I looked at is I focused on a single market right now. This is presentations, this S&P total return. And by total return, I mean with dividends reinvested. And I looked at it from 1835 to 2000. Actually, it's now, I updated it a little bit. It's 2018 in this presentation. And I use Global Financial Data, which is a database we subscribe to, which has basically, a huge amount of data from many, many markets throughout the world, right? So I have some questions, how can drawdowns be modeled and analyzed? How stable is this aspect of performance? And then what insights can we develop examining the drawdowns in major markets? Again, I've sort of abbreviated this to just the US market right now. Why isn't this? Why isn't it letting me? Okay, all right. So now, why is a drawdown important? Well, if you've lost 10, it's not, losses and gains aren't symmetrical. If you lose 10% of your assets, well, you have 90 cents on the dollar that you have. So to get back to where you were at, say, 100%, you have to actually make 11%, not 10%, right? So it's, if you lose 20%, you have to make 25% in gains to get back. And you take it sort of a more extreme case. If you lose 50%, well, so you start out with $1, the market goes down 50%. That market now has to double to get back to where it was. So, it's drawdowns and the period down. The loss has a huge impact on your future ability. So again, you'll see things like people will say, "Oh, the market was down 25%, but it's up 30% this year." Well, that's you're not ahead, you're not really ahead there. In fact, if you loses 25%, right, so now you're down at 75 cents on the dollar, right? It makes 30%, right, which is what, 22 cents on the dollar. You're still down roughly 3%. So again, you have to sort of, people just don't internalize this properly. I mean, they may even know it mathematically, but they don't sort of think it through. But drawdowns are really tough on a portfolio. Now, this is the S&P 500. This is a log index plot, and you can see here, the drawdowns are shown in these pink periods. So it's as if you poured water on this thing, and the water sort of collected in these little sort of valleys. And you can see, for example, this obviously is the Great Depression, but there was a depression in the 1830s, and also, a big drawdown in the 1830s, the 1870s. There was a series of smaller things over here, the depression, and that was a very long piece. And then, even though we're, right now we're looking at this sort of steady period of growth that we have over here, and everybody's saying, look, for a lot of people, who are looking at over the last 10 years, they're saying, oh, the market's always goes up. The market is, and you get used to that. But the reality is that, from the drop that we had, the original drop that we had in 2008, it wasn't until 2013 or so that we actually made back what we had lost. So a lot of this upward period you see is just making up for lost ground. It wasn't, we have a tendency to just tell ourselves stories without really looking back at the past accurately. So now what I'm going to do is I want to look at these drawdowns as a process, right? So what I'm going to do is just flip it around, and this is the drawdown process, right? And you can see, where these things, and again, this is a log drawdown, which is, and again, I've expressed these as positive numbers just to make some of the modeling easier. And you can see this is what they look like, And as you expect, you can see you're in a drawdown, really 75% at least of the time, which again, I don't think is sort of well appreciated. Again, if you're a long-term investor, like an institutional investor, and you're looking back at where you were at some point in the past, 75% of the time you're actually below your prior high. Psychologically, I think that affects people more than we realize. But now the question is, how do I model this thing? How do I sort of look at this thing? Is there any pattern here I can discern that kind of makes sense? So how do I model this thing, right? So one of the things I said, okay, well, what if I just dealt with an IID process? What would that look like? And it turns out that, for a wide range of processes, the drawdown should be, the size of the draw should be essentially exponentially distributed. But that's not what I found. All right. Now, what happened is that, so again, here what we have here is an exponential distribution. But, I said, okay, well, what happens is that, the drawdown suggests that there's these regime shifts going on. So what I did is I said, well, what I'm going to try, and this was the first thing I tried. I didn't go around hunting around for a lot of different things. I simply said, well, look, a natural, if the rate parameter of the exponential distribution, what's a good sort of way of modeling that as a hyperparameter? Well, the natural thing for a rate parameter is to use a gamma distribution. So that's what I did. So what I have is an exponential gamma mixture. So what you do is you basically have the lambda is following an exponential distribution. Then you have the exponential distribution here. And what you do is you integrate out lambda to get what's left. And what you end up with is a variant of a Pareto distribution. And it's a specific form called the Lomax. But it has the basic form of a Pareto distribution, and including the fact that you have this exponent, the -1 plus alpha, or 1 minus alpha, however you want to look at it. Yeah. So okay. So you have this sort of power law here effect here, right? So, and that's when I looked at the actual distribution. Right, here's my probability plot. Now it turns out a Lomax distribution, I did this in Mathematica, a beta prime distribution, it's a special case. The Lomax distribution is also a special case of what's called a beta prime distribution. So what I did is I fit a beta prime distribution to my drawdown, right? My drawdown depths, that I observed. And I compared that to the beta prime distribution fit. And the probability distribution is a plot of the two CDFs, right? And you can see here, this is a dead on fit. Right, it's really dead on. If you try doing something like this with almost any other distribution, wouldn't fit as well. So basically, the basic thesis was that, look, I have this thing which, under normal circumstances is exponentially distributed, but that rate parameter is unstable and it's moving around. It's itself a random variable, and yeah, you get pretty much an exact fit. Okay, and another way you can sort of detect a power law is, again, so what I looked at is that I looked at the survival function, which is the probability at a given, if the survival function at X is the probability that X will be greater than that value. And what happens is that if you're dealing with a power law distribution, hold on a second. If you're dealing with a power law distribution, what you find is that the tail, as you go out in the tail, the survival function is essentially proportional to X to the negative alpha, whatever that basically exponent, where L of X is basically a slowly varying function, basically where the ratio of X and X plus epsilon goes to 1 as you go to infinity. So essentially what happens is that you end up, once you get past sort of an initial period, you're in that sort of power law tail. And you can see here that when I plot this, you can see that the tail end here is linear in log space, right? This is the depth of the drawdown, the log depth, and the log survival, right? So you can see we really have here a power law tail. Now, what's scary about power law tails is that they're fat, they're really fat, And in case here, the alpha of this power law tail came out at 1.9, which means that it's basically, such a distribution doesn't even have a variance. It only has a first moment, and the variance doesn't exist. If you try to compute a variance, the integral doesn't converge, right? So it's indeterminate. So you're dealing with a very fat-tailed process. And when you're talking about things like drawdowns, that's kind of scary. The idea here is that, when we talk about portfolio management and risk control and stuff, we tend to try to think of it maybe sometimes too abstractly. The fact of the matter is that people build portfolios to serve purposes, right? So you build a portfolio to fund your retirement. You build portfolio to pay pensions. You build portfolios, endowments, say in colleges, to support programs and give scholarships. So when you're dealing with something like a drawdown, it can have a serious effect on what you're doing. Let's say you're a college endowment and you're sort of committed to various programs to pay out 5% of your investment corpus per year, right? Whatever that is. And that, for example, that you've done some Monte Carlo simulations and did a lot of tests, and you figure out that your long run average is going to be about 8%. And so you have a pretty good safety ratio there where you can basically pay out continue to pay out that 5%. And if you have a bad year, well, you can sort of pony up a little bit more money because you'll eventually make it back. And, everything's wonderful. But then you have a 50% drawdown. And all of a sudden, that 5% that you've been giving every year, now relative to your portfolio, is 10%. So you have a real problem. If you continue to pay out 10%, right? You're going to eat, you're going to start eating not the fat, but the bone, the meat and the bone as well of that portfolio. The portfolio in total is going to shrink over time. But if you don't pay out the 5%, that what used to be the 5% and is now 10%, you're going to actually force to cut back programs and not give scholarships and all of the political stuff with that. So, and the same thing for pensions. You know, you're supposed to be paying there. You don't have a choice. You have to pay out the pensions. So what do? You have to either raise contributions for people who haven't retired yet, so you're going to have enough money, or you're going to have to do something. You're stuck, right? So the idea that that if you have this drawdown behavior, that's much worse than you might expect, and you don't bring that into your plans, this can be very, very serious. And again, as I said, a lot of people will do these Monte Carlo simulations, but since people kind of, the kind of, state of the art knowledge now is that, returns are sort of IID, independent, identically distributed. So what you do is you sort of look at the distribution of returns, or you do something like a bootstrap and you sample from past returns, and you just use that to project into the future. You're going to get estimates, and you're going to get you're going to get something that looks a certain way, but it's not going to have those deep drawdowns that real data has. And that's very, very serious. Okay. All right. Now let's get this. So now what I did is now let's look at the length. And again, when I looked at the length, it turns out, and again, it turns out the length follows also the discrete analog of a memoryless process, which is what an exponential distribution is. Again, if you look at things where you do have IID random variables, the length of such drawdowns tend to be geometrically distributed, right? But again, it's the same idea. And now again, the geometric distribution is driven by P, which is a probability parameter, right? It's P between 0 and 1. And again, a natural sort of way of looking at the distribution for that as a hyperparameter is a beta distribution, which varies between 0 and 1. So again, what we have here is a beta Pascal, because Pascal has a whole complex of distributions of which the geometric is one. So it's a beta Pascal mixture. So again, you do the same thing. You have a beta distribution here, which describes the behavior of P. You have the geometric distribution of P here. And what you do is you integrate out the P and you get a result. And what that result turns out to be a variant of what's called the Waring-Yule distribution, right? Which is, again, a common thing. And although it may not be obvious yet, this too is a power law tail, has a power law tail. And again, so here's a plot of the data of the data versus a beta prime distribution. And you can see here, we get a pretty good fit. We got a little bit over here, but this is not so serious. But notice this goes all the way out, way down here, right? It goes all the way out, right, to here, which is the, it's kind of remarkable, which this point here is, this is the Great Depression, which is way out here. But notice, if I didn't have the Great Depression, and if I didn't have the Great Depression, and I just had this where I had a fit aligned to it, I could very easily have predicted, at least I'll give a probability estimate for that Great Depression. Then there's the Great Depression here, and this is important to understand. The Great Depression is not a black swan, because there's no reason why we wouldn't have predicted it under this model. The Great Depression isn't even an outlier, because an outlier, you typically mean something that was outsized, maybe outside the realm of the model, or some unusual event that you really maybe didn't want to put in your analysis. But the reality is here that these huge drawdowns that we see are perfectly consistent with the probability distributions that you fit. And as a matter of fact, we'll see in a minute, even if I drop the Great Depression and I don't use it in my fit, I get the same distribution, right? So in other words, the presence or absence of something like the Great Depression has no impact on the model, because it's simply, the model is entirely consistent with it, okay? And now so what that also means is that if you believe this model, could certainly happen again. Again, Great Depression, by all means, is not a common event. It's a rare event. It's just not outside, it's just not an unusual event, right? In the sense that it's not something that you wouldn't have expected to see, given the model. Where, for example, if you really believe something is normally distributed, you pretty much never expect to see a 6 sigma event. If you really are if the thing is really normally distributed, you know, that's like a 1 out of a trillion probability. You don't really expect to see that. Here, no, you know, it's a perfectly reasonable thing to see. Okay. All right. And again, this is a discrete distribution, but you can see here again we have this effectively this power law tail, right? With the slope here, right, is alpha, and the slope here is what is it here? It is 0.17. Okay. 1.7. I'm sorry. Sorry. Okay. All right. So again, very fat-tailed, right? Now, you know, this thing has some serious, you know, it's kind of scary, you know. So when we look at the drawdown distribution, right, the simplest situation is to assume that the return process consists of IID random variables. That is obviously not true, right? It's clearly not true. And also where people have tried to sort of say, oh, well, we know that already because we have things like Arch and Garch, which show us that, you know, we can model that volatility itself as a stationary process, and then we can sort of fix everything. Well, no, that fixes absolutely nothing because you still don't get these kind of drawdowns, right? As I say, so fairly simple arguments supported by simulation studies tell us that the depth of drawdown of an IID process will be exponentially distributed, and it doesn't look anything like that. It's got huge huge downward tails, right? The data for market drawdowns is profoundly different, right? So again, let's go back to how can we model them? Well, we've sort of answered that. How stable is this aspect of performance? That we're going to do that in a minute. And then we're going to talk, as throughout this, we're going to discuss like what insights can we develop from this study, right? So let's look at prior to the Great Depression, right? So now we've gone from 1835 to 1928. So we've excluded the Great Depression, and here's the drawdown process, right? That's great. Well, when we fit a distribution to that period and we compare it to the full period, look at it's virtually identical, right? Virtually identical. Right? And what I did here is it's pre-Great Depression, right? All right. So now I'm going to look at post-World War II, because again, I you know, even after I didn't want to include World War II, nor did I want to include the post-World War II you know, sort of mini depression we had as when people came home and the economy had to readjust. And the reason I didn't want to do that, the reason I don't want to do that, so obviously I didn't want to do the Great Depression, I didn't want to do the dislocation for World War II, and I didn't want to include the recession that lasted until about 1950. And the reason for that is I was trying to give the current period every chance to look good, to see how robust this result was. And this is the result. So what we have here is, here's the full period, and here's the distribution for Percival. So clearly, I still have a power law tail, right? Now again, the post-World War II is a little bit different, but you know, again, you know, we're dealing with essentially, you know, virtually identical behaviors, and when you look at these things, right? You can kind of bootstrap a sampling distribution. Here's, if I fit it just from 1835 to 2018, I mean, the whole period, this is what I get, you know, it hits at the mode. If I do the pre-depression period, which is this, I get this, and I get 1951 to 2018, I get this. So, and this is a 95% confidence interval, right? So, you know, what I have here is basically, you know, statistically, these results are indistinguishable from one another. Now, this is kind of interesting. Now, what I'm saying is that if you look at this aspect of market stability, you know, which is basically how bad can things get before they get better? You know, like, you know, how bad can this market go down? First of all, something like the Great Depression, you realize is not an outlier, because putting the Great Depression in doesn't change anything. So it's a big number, it's a big event, but it's not an event outside the realm of the model, right? So that's right. The second thing is that this is a behavior that's lasted from the early 1800s to the 2020s, you know, basically, you know. Now, just look at how profoundly things have changed. We think profoundly things have changed. We had the development of the Federal Reserve. We've had tremendous changes in certain terms of laws and regulation. We've had the introduction of economic theory in terms of like Keynesian economics, which has been used to help manage the country fiscally and monetarily. We've had an explosion in regulation and oversight, things like the SEC, and all of these things have been sort of put into this market. We've had tremendous technological innovation, where we have now computers doing all sorts of high-speed computations and high-speed trading operations. I actually worked when I was in high school in the late 60s. I actually worked as a messenger on Wall Street. And I remember one day they hit a $25 million share day. And they had to work all night to get everything processed so they could open. And they had to open a little late the next morning because they had never seen that much trading in one day. Now we trade, thousands times that, we could, so, there's been profound changes. The costs of things have changed. The oversight has changed. There's government and semi-governmental institutions are in there managing things and overseeing things. Yet there's no evidence that markets, at least in terms of this measure of stability, have changed in any fundamental way. Right? So the idea that, for example, we can sort of count on not having another depression is not something I would be comfortable saying. Right? So, what's some of the conclusions of this? First of all, I think that if you're going to sort of analyze this stuff, you have to be a good historian as well as a good analyst or an economist. Right? You have to take a long historical view, right? Because you can learn a lot. Either things will change and you'll see the nature of the change, or things won't change, and that's interesting as well, right? It's also very, very interesting that certain market characteristics are stable, despite immense changes in the science, the technology, the laws, the policies, everything, right? Market drawdowns as a driver of regret, plays a significant role, maybe greater than we realize, because these things are deeper than we like to think. This is very scary. Conventional stress tests do not capture the true drawdown behavior of financial markets, and that's very, very serious, right? And again, just as a counterpoint to that, it would be a mistake to view the Great Depression as an outlier. It's a rare event, but it's not a impossible event, right? I don't know. Somebody's doing their lawn outside. Perhaps again, if you look at other histories, you find the same thing over and over again in market after market. Now, very few markets have this much data, but again, if you look at the data that's there, you get the same sort of patterns and the same sort of predictions of potential immense drawdowns, consistent with the basically the tail exponents you see, right? And that's it. Hold on a second. Okay. All right. So the idea here is that first of all, I think we need to do more analysis where we sort of look back over the long horizon, because otherwise you start to say silly things. I remember going into 2008. Remember I've been doing this since the 80s, so every time somebody says now it's different and markets are going up and everything's wonderful, it's usually right after that things go to hell. And we do it to ourselves. What happened? I mean, if you read people like Hyman Minsky, who's an economist who look very deeply into things like why do markets go through these sort of cycles and that sort of thing. It's in part what happens when things are good. People get overconfident and they begin to over leverage, and their systems become increasingly fragile. And so what happens is that they get themselves into a state where they're making more and more money. Everything looks wonderful. It's been going on but they get to a state where a random perturbation, which a few years before the market could have weathered, actually triggers a cascade of failures in the market, and the whole thing collapses. And if you look at beyond financial markets, if you look at, say, the literature, the broader literature, there's a sociologist, an ethnologist, Jared Diamond, who's written a book called Collapse. And this happens to societies as well. And he talks about, for example, certain societies where they had a period of, because climate goes in long cycles. So they had a period of very good climate where they had a lot of rain. And so what happened is that the population exploded. They built all this irrigation stuff. They had all of this, they had more food than they knew what to do with. And then they hit a period of drought and the whole society collapsed because they had no They weren't storing food because they never had to store food before. They just got used to everything being great. And so this is a common in systems. This is a common behavior that goes far beyond financial markets. And, we have to understand that because, we live in the real world, right? And this is what happens. So I hope this, stimulates you to sort of, if really to think about long-term issues like this, because sometimes it's the only way to see patterns that emerge over long periods of time. And it also helps to sort of fight the myopia we have a tendency to develop. Because, if you look at, the last really big, hard drawdown we had was 2008. Yeah, we had a little bit of a drawdown in 2019, but we recovered from that pretty quickly. But 2008 was kind of a big deal. But, probably, that was 13 years ago. Well, yeah, 13 years ago, right? Well, maybe 12 years. Let's go to 12 years ago. It was 12 years ago. A lot of people working today who have a decade of experience haven't been through something like that. But yet these things happen fairly regularly over time. And so, it sort of is a good idea to kind of know what history tells us, right? It's also interesting to note that despite everything we've done, all of the safeguards we've put in, all of the technological improvements we've done, there's something fundamental about markets, these financial markets, that hasn't changed. And that's, I think, a very interesting question to go deeper into.
Thank you, Dr. Frey, for the presentation. I think for everyone here, I speak for myself, but I'm pretty sure everyone probably shares the same sentiments that this was a really great insight into the usage of math and statistics into explaining real world phenomena. So this is from Nile. Do these models that you've looked at fit across markets as well?
Yes.
Not just the S&P, but
no, yeah, they fit across market. Yeah, they do. Yeah. Yeah, I would have gone into more. I thought I had less time, so I kind of pared down the presentation. But yeah, I mean, almost virtually any stock market you look at, so far every stock market I've looked at has had this behavior. Yeah.
So I think your colleague Nassim Taleb, he mentioned in his book, right, about the fallacies of just this narrative bias. So from our perspectives, looking back at history, sometimes we look at maybe some correlation and we try to fit a sort of, an explanation to it. And this could be a little bit dangerous. And for you, I think you haven't done that in your presentation, but could you maybe elaborate your thoughts on this?
Well, about why does this behavior exist? Well, I think there's that pattern that, what is it in the Bible? They talked about 7 years of famine and 7 years of plenty, and, things happen in various ways that, you'll have, when we're talking about sort of social systems like markets and that sort of thing, we caused the 5 years, the 7 years of famine, we caused the 7 years of plenty. So what happens is that, we've gone, typically after we've gone through a rough period and things have organized and we've made things have pared, Jesus Christ. We've pared down the economy. We've pared down the economy to, to make things more efficient and, great suffering, but now everything is running efficiently, right? Everything looks good. We start to make more money, people are making more money. But again, so we're in a sort of a lower risk environment, right? There's not a lot of leverage around. But the first thing people realize is that, oh, wow, I can, I'm making all of this money, but if I, leverage it a little bit, I can, really make a lot more money, right? It's the idea is that, I have, and what the argument goes, I have a very high Sharpe ratio. It makes sense to lever it up because, I can keep that same Sharpe ratio, but, make more money, make more money off of it. So people do that either through direct leveraging or simply through taking on riskier bets, because they're comfortable with the risk because things generally have been working out. And as time goes on, people get more and more used to this behavior. They do it more and more. The people coming in, new people coming into this situation, look around and see everybody else doing it, and they think this is the normal thing. This is what everybody does, so I'm going to do the same thing. Because I don't want to have that regret of not making as much money as all these other guys. And they've been around for a long time. They seem to think it's okay. And what happens then is that the system becomes more and more fragile, and then all of a sudden, there's some random stressor that hits the system that under other conditions the system would be able to adapt and absorb and adapt. But now, because things have become so fragile, so dependent on everything working out exactly as expected, that you get this cascading failure, and the whole system begins to collapse. And I think, you see that happening, usually. If you look at, say, the period going up to 2008, market volatility was at historic lows through that period, right? And so if you're modeling things and you're looking back over 5, 10 years and you're looking at market volatility and you think, because what a lot of people think is, if I look back on my data, say 10 years and look for something, and I see a pattern there, I'm pretty going to believe that pattern is going to be the pattern of the market. Well, the answer is that no, these things emerge over much longer time periods. But again, so if you're in 2007 and you're looking at the recent market volatility, you're going to say, well, that's the market volatility. But you've grossly underestimated the potential because you just happen to be in a good period. And then what happens is that people they become committed to things always going up. So, I mean, 2008 was a lot, to some extent, caused by real estate. And again, people were sort of saying, well, what people would do is they would, in fact, I knew people who did this. They bought a condo on spec, and they put 10% down on the condo, and then when the condo was built, they were able to flip it for 30% more than they bought it for, or 20% more than they bought it for. And so they put 10 cents down on the dollar, and they got $1.30 for the condo. So they actually made like a 200% rate of return. So they said, this is great. So they took that money and they bought 2 condos because now they're a little more comfortable with it. So they bought 2 condos, and the same thing happens again, right? Wow, look at all this money I'm making. And they do this over and over again. They say, gee, things always go up. Isn't this wonderful? And then what happens is that they have a huge market. So now they have eight condos that they're holding out there, expecting to flip at the end, and the market goes down 20%. Well, now all of a sudden you've lost everything you've made, right? In that one downward event, you've lost everything you've made, and you default on all of these. You default on all of these mortgages, and on all of these sales. And the guy who's trying to sell it can't sell it for what he built it for, and he starts defaulting, and then again it just cascades, right? Because it's and I say, like I said, if somebody had put down some money and they had one condo, which is what they kind of did kind of nervously when this thing first started, if they had stuck with that behavior and, you had a drawdown and, you had a drop in housing prices, it would have hurt a little bit, but people would be okay. But if you're really out there strung out with, high leverage over many, many things, many times your net worth, well, what's going to happen is when things get a little bit bad, it's not going to be little for you. It's going to be disastrous for you. Well, you can sort of translate that into almost anything. The stock. I mean, what happened in 29? People again thought that stocks could only go up, and what did they do? They levered the hell out of everything. Right? They bought on margin, and when things got a little bit dicey, the whole thing collapsed because people couldn't meet their margin requirements. But the actual event that caused the Great Depression wasn't that event, that trigger wasn't that bad. It's just that the system had become so over leveraged, it had become so fragile that it couldn't sustain any kind of perturbation. And that's really what we're dealing with here, and that's going to happen probably again because human nature hasn't changed. But it's very interesting how consistent this is over time. That there's very little evidence that all of the stuff we've done has really fixed this problem.
Thanks for the presentation.
Sure.
Yeah, just wanted to ask, as an investor, if we acknowledge the presence of these kind of long-term cycles, right? How will we practically incorporate that into a strategy? Because say right now it's been 12 years since like the last 2 sigma. So even though we know that eventually it's going to happen again, whether we believe it's going to happen in 1, 2, or 3 years, I think makes a huge difference to how you invest, right? But
right.
It's not something that the cycles can predict. And maybe just add on to that also, like I'm not sure if like the AQR CEO Cliff Asness, he was looking at he was arguing that the value factor kind of is still valid, but he's talking about, valuation changes have covered that on the time scale of 30 to 40 years, right? So if that's the kind of long term that we're talking about, and you say, some things are still cyclical in the long term, but practically, how can we incorporate that into?
Well, actually, that is an area of research. The idea is that when you have these regime shifts, and you do have these very distinct regime shifts, how do you sort of what presages those? What helps predict those things? And that's kind of right now an active area of research, and I don't want to really talk about it right now. Also, too, I don't want to start giving investment advice, except in a very general sense about these findings. But the answer is yes, you have to look at things, and but I would say that part of the problem is that when markets get into these, you can know when markets get into these sort of potentially unstable states. And the term scientists use, a metastable. A metastable is where right now things are stable, but if anything changes, things become very unstable, right? So it's only stable in this very narrow regime, and if things change, it collapses. So you can I think detect that metastability in markets by looking at things like how much leverage is being taken and what kind of risks are going on, various economic measures. But you can't predict when the actual event is going to happen, and that's a real issue. And there are people out there who are the people out there who sort of believe that you should sort of maintain this sort of big out of the money hedge. The trouble with that, of course, is that it can be expensive, and if the good times go on too long. See, here's the problem: if you actually build this into your thinking, you can protect yourself, right? But if you're say a fund manager, over the short term, this tendency to not to take some of these risks will mean you'll tend to underperform your peer group. Now, in the long run, because when these loss periods hit, you're not going to go down nearly as much. In the long run, you'll outperform. But the trouble with the long run is that sometimes you don't get to live in the long run. Sometimes in the short run, you go out of business because people don't give you money anymore because you're underperforming. So it's a real agency problem, because even if managers know that these things can happen, there's very little incentive for them to do it. There's much more incentive for in the moment to sort of follow the herd, which is doing all of this stuff. And I don't have an answer for that right now, because unfortunately it's just the way people think. But of course, if you're talking about managing your own assets, you can do things your own self, but then you have to be willing in the short term. Like I said, when times are really good, you're going to underperform, right? But that's the same argument for anything. I mean, if you have a house and you don't buy fire insurance, you'll actually live better until the house burns down. Right? I mean, you'll have more money. You don't have to pay, you don't buy insurance. Everything will be great. You'll have more money to spend. Everything will look wonderful. And then as long as you don't get a fire, you'll look great. But if you do get a fire in the house, that insurance becomes very, very important, because you could lose the whole house if you don't have otherwise. So it's the same thing here. And until maybe if people are better educated about this, or it's more widely accepted, you're going to find that people will continue to continue to push the envelope as much as they can and get themselves into increasingly fragile positions. And then when that hits, and again, what happens is that, like I said, there's a herd instinct. So people are told that, well, you should, everybody should be just, buy index funds. And, I guess that's fine. But what it means then is that, if you have this big market drawdown and you're part of that drawdown, you can say, well, look, it's not me, it's the market as a whole. You could ask well, why did you sort of do what you did? Why didn't you do something different? No, but that question is not what's asked. People they've been drilled in to sort of follow benchmarks, and that's the way to do things. And part of that is this sort of argument about efficient markets, the efficient market hypothesis, which is kind of nonsense. I mean, I made a very good living for many years based on that being false. So I don't know. I mean, I don't really, believe that very much. I understand the arguments, but the arguments are rough approximations to what really goes on out there. And so there are forces in there that tend to create certain equilibria, that there are equilibria where things tend to, but they never actually get there, right? And there are also long-term structural things that happen like this, where you get this sort of these instabilities. Again, if you look at Ray Dalio, he talks about the debt cycle, and there's a small debt cycle where you have little ups and downs, and then a big debt cycle where you have big ups and big downs. And I think that's really kind of driven by the same thing here. People sort of get used to borrowing too much money until all of a sudden everybody has too much debt, and when something happens, you get this cascade of failures. So it's the same process we're talking about here. But as far as that, I mean, I don't have an answer for how to fix the industry about this. I'm just observing. I'm a scientist observing the behavior right now.
The story was that you were in academia for 16 years and actually still is very active. And you got a bachelor's and a PhD in applied mathematics and statistics at Stony Brook University. It's one of the best applied mathematics universities in the world. So could you share your experience at Stony Brook?
Oh, well, I was, I had a sort of misspent youth. So I went back to college after I was married, and I did my undergraduate and graduate part-time. So it took me 14 years to go from that to get to finishing my PhD. And I just got a lot of support at Stony Brook to do this. I mean, they really just gave me any kind of flexibility they could give me, they did, so that I could finish. And so I mean, it was just a great thing. It was hard because you work and all that. I very rarely had a job that was a 40-hour-a-week job. It was usually a job that was pretty demanding. And then to have to go to class at night or try to get off during, work with my employer to get off during the day to get to a class, and then all the studying and work that had to be done. It was a tough haul. But I think one of the benefits is that I was working in areas where I was actually using the stuff I was studying. So it really, very early on, I got that really good tight connection between theory and practice, because I was working as an engineer and then later on as a quant, and I was able to use the stuff I was learning very productively. So yeah, that's okay.
Oh, well, so like many best quants in the world, you obtain a PhD, and your dissertation was about matroid theory. So for those who have no idea what that is, could you give a very quick summary of what a matroid?
It's nothing to do with finance. A matroid is a topological concept where you have a family of sets, right? And those sets have certain behaviors. They follow certain things. And it turns out that when they're really generalizations of a lot of things in mathematics. So, for example, if you look at a graph, I mean, a network, the set of circuits in that graph or the network defines what's called the set of those circuits, and the way the circuits combined, that forms a matroid. Now, an alternate way of looking at that is to look at any trees. A tree is any a cyclic path that doesn't have cycles. That also is a basis that you can use to form a matroid structure. And those things have certain characteristics that attach to them. But what's also, say, for example, a matroid is if you look at a matrix and you have the columns of a matrix, well, the set of linear independent columns in a matrix form a matroid. And what you can do is you can actually if you look at the pattern of linear independence in say a matrix, and you look at say, for example, trees in a graph, there's the way the sets behave are exactly the same. You can write the same set of axioms to describe what's going on that apply to both. And so this is a generalization of a lot of different ideas. And so when you look at, say, when you look at sort of graphs, there's a sort of that deep connection where you can actually use one to model the other. And this is very important in areas of, say, mathematical programming, where things have to be integer valued. It turns out that you can look at certain matrices, for example, guarantee that the solutions will be integer valued. Now, how can you tell that? Well, what you do is you can tell it by looking at the underlying matroid, and that will tell you. Now, if you're, what's interesting about that is that you can, for example, if you have let's say a very complex optimization problem, but you have to have integer values. What you can do is you have this sort of matrix of constraints. What you can do is you can select some submatrix of that of those constraints, right? Which will guarantee integer solutions. And then the remaining constraints, what you do is you do a Lagrangian pricing. You price it out into the objective function. This is called Lagrangian relaxation. So what you can do is you can solve these problems much more efficiently because you're basically the basic program is guaranteed to stay in the integers, and then you have these other constraints up here. You put them in as penalties, and what you do is you gradually you solve the problem and gradually tighten the penalties, and a lot of problems that would be otherwise completely intractable you can solve with, say, matroids. It turns out that a lot of problems in network theory, again, that are very hard to understand and very hard to model, it turns out when you use matroids to model that, the theorems get simpler, the ideas become simpler. Working with the data, it's kind of this odd thing by taking this network and viewing it in a very abstract way, you actually simplify a lot of the problems. And so that's and I was working with a gentleman, my advisor was Ellis Johnson, who is really a giant in the world of integer programming. And so that was sort of my focus, was combinatorial analysis, combinatorial programming. And that's what although the PhD was actually in the operations research track. And like a lot of people, I noticed a lot of people who got into became quantitative finance people, they came out of operations research, and I saw that too in the way a lot of programs developed, like in Cornell and Princeton. It was the OR group that first started the quant finance group.
After you've earned your PhD, you went to Morgan Stanley, and you shared earlier how they really try to get you to join their team through financial incentives. But aside from that, why did you make the switch to finance?
Oh, well, first of all, what happened? Okay, here's what I mean. I was working in defense, and I enjoyed it. I had, basically, I was working as I was managing a group. I guess you'd call me a systems engineer, basically. So I was looking at the overall system and, sort of optimizing the overall system, so doing things like avionics, radar systems, anything like that. So, I got approached by someone who said that, you should come and, talk to these guys, my advisor. So I went and talked to them, and they said, what they explained what they did. And I said, at first, like I said, I said, why do they want to talk to me? So I talked to them, and it sounded interesting, but I said, I have a career here. I'm doing well. Thank you, but it's interesting, but maybe you should look for somebody else. Well, I guess they knew my advisor very well, and frankly, if you go for if you're getting a PhD and your advisor can't give you a good recommendation, you're in a lot of trouble. So he really sort of pumped me up and said, this guy's great, you got to hire him and stuff. So they came back, and they couldn't find anybody they were happy with, and they said, look, what we like is that you have your PhD, but you've been working on real practical problems for several years now because you got your PhD. So we're really kind of interested in you. You're a little more mature than the guys coming right out of school, and you've actually worked in, been successful in the industry. I said, oh, thanks, and so they offered me more money, right? So I said, oh, so I said, no. So the third time, basically, they tripled my salary, what I was making as an engineer. So the main reason I went, it sounded interesting. I wouldn't have gone if I didn't think I would have, if I thought I was sort of ruining my career or something like that. But it sounded interesting, and they offered to pay me a lot of money. And I said, I'll take money. That's a good thing. And when I got there, it was actually interesting. These were, what I found is that when you're dealing with these kind of problems in finance, they're really tough problems. They're really very difficult problems, and much more difficult than what I was doing. So I got really interested in it. And I had a good time doing it. I enjoyed the challenges. So that's how I got started at Morgan Stanley. And then, like I said, Morgan Stanley, the managing director who was managing that at the time, there was some issues with him, political issues. I'm not sure I quite understand it, but I sort of decided it was time to sort of move on after a few years. And that's when I had met Jim Simons, because he was the former head of the math department. I was in applied math, but he was former chairman of the math department. And I met him at some fundraising stuff, and he asked me what I was doing, and I told him and stuff. Well, it turns out that he got sort of interested in that. At one point, myself and another guy who had actually also gone to Stony Brook wanted to leave. So we started talking to him about it, and that's how we started Kepler. Kepler went on for a few years, and then we got this offer. Why don't you just guys all come over to Renaissance? And I negotiated a deal where I basically, got shares. I exchanged my shares in Kepler for shares in Renaissance, which was the smartest thing I ever did, frankly. And I worked there for several years, and then, like I said, when I turned 50, I decided to to not retire, but to do something different. I mean, when you work at Renaissance, it's a great place to work. It's really, you have every resource you need. There's very little sort of bullshit you have to put up with and that sort of thing. But you do work hard. And at this point I said, well, I'd like to sort of focus on things I'm, sort of want, not be so hyper focused on something like this where I can't sort of have anything else in my life. So I decided to leave, retire, and I negotiated how they're going to buy me out. And it's actually, I was able to negotiate some pretty decent terms because, I was one of the early guys coming on. And, then I wasn't even sure what I was going to do, but I actually got offers in industry. I got offers from, let's say, 2 universities. And I decided, well, I'm going to try the professor route, and especially the offer from Stony Brook, where they said, you can start up this program, you can start up this track within applied math. Because the way applied math is organized, it's the graduate programs are organized along tracks. So you have an OR track, you have a statistics track, you have a computational math track, you have a bio track where they do they do the model things like protein folding, and you have now a quantitative finance track. And so I got to organize that, be the director of that. And, that was kind of an interesting challenge. And, I had the experience of developing the courses and putting everything together. So I had a great time doing this, and I found teaching very satisfying and helping people with their research very satisfying. And at the same time, I still kept my job, and, it's kind of a job as managing, quote, money, but it was my own money, in terms of like getting in, diversifying my portfolio and, hiring people to help me manage all that stuff. And so it's been a kind of a good run, and right now, I have, I'm almost 70, not quite 70, but I have no desire to slow down or change right now.
So let's rewind a little bit, right? So you spent 12 years at Rentec. You built really successful product lines like Equimetrics, Nova Fund, and Meritage. Right. And you had an insider look at Rentec. But what do you think is the key to its success?
Well, one of the things is that, we were very disciplined and rigorous at Renaissance. We tested things. We were not in a hurry. When some of the stuff like Nova, which is, a big part of Renaissance now, it took, when we first started it, we realized that as important as the forecasting, the predictive part, was the sort of the operational part where you sort of got the orders down to the floor, and that you figured out how to trade as cheaply as possible without disturbing the market. And so, so we realized that we had a whole other level of research to conduct in order to get this to really make as much money as it does now. So we were very disciplined about this. We didn't deploy things prematurely. We tested things out very, very rigorously. We tried to have simulations that were as realistic as possible when we did this. And it was just that process that was very important. Also, it was a challenge because you want people to be creative and work hard, and at the same time, you want to focus them to work on what you need them to work on, right? So sort of the management technique that was used is that we would have regular research meetings where we'd have people present what they were working on, and so what that meant was that people, if there's anything that motivates, say, your typical sort of research type person, because we had a lot of PhDs there and stuff. It's peer pressure. It's that he or she wants his peers to like what they've done. They want that sort of, they want to sort of. So what would happen is that, if people, that was a, that worked much better than having a manager give this guy an assignment, right? Right. So what we did is we tried to run it like a research department, but a very focused research department where basically everybody reviewed other people's work, and not in a challenging way or a comfortable way, but just so, we tried to make things as constructive as possible. But people wanted to do well in that environment, and people generally worked hard so that people could see them making a contribution. So that peer pressure became very, very important. And I said also, there was just this overriding idea of, you don't do a sloppy job. You really make sure you hit all the things you need to hit. So that sort of discipline was very, very important. One very important thing we did is that we organized the data. We had in fact, the largest group within Renaissance was the data group, because when a researcher sits down and wants to try something out, you want that person to have easy access to the data that's been curated effectively and organized so that that those people can use it very efficiently. They don't have to they don't have to sort of write a lot of stuff. And anybody who's used financial data realizes that, sometimes half of the job is just getting the data in, cleaning it up, taking out the obvious errors, getting it organized into some sort of format. So if you've done that for them, you increase the performance of that person by 100%. So it's things like that we did. We were very careful about thinking about where we spent our resources, how this focus on being very disciplined, the idea of sort of mutual peer pressure on everybody to contribute to this, to contribute to things. And so any of the things that you see in Renaissance there, they are pretty much group efforts. A lot of people made contributions to all the working parts that those things represent. And I think it was also, but you say it was an environment though that wasn't hostile to people. So people enjoyed working there. They wanted to work there, so that's really, I don't, I think that, Renaissance's big secret isn't a big secret. It's just that we just tried to, we just tried to, respect people's skills and respect their focus, and to provide that discipline without being overbearing, and because you can't, if you want people to be creative, you have to have that sort of looseness in there. And at the same time, if you get a bunch of smart people and you just give them, a lot of resources, it's going to be like herding cats trying to figure out how to get everybody to go in the same direction. So that peer pressure aspect of things, where people were working on things and to improve this product, that became sort of a key element to the management of how people done. And so, in people's mind, it felt like everybody was managing themselves. And they were, except it was in the context of the peer pressure that we maintained.
So I just wanted to hone in on one bit that you mentioned about, which is the data, right? So in the book, The Man Who Solved the Market, one of the greatest takeaway was really how deep the data moat was for Rentech. And right. You guys collected such a huge database of cleaned data as well. So could you share how big of a moat this is, a competitive advantage this is? Is it replicable? And maybe for people who wanna get into quant, would this prevent them from getting as successful as Rentech, or what are your thoughts about this?
I guess what I would say is that if you subscribe to somebody else's database, what's going to happen is that if you try to use it like as a product out there, it's going to have all kinds of errors in it. It's not going to be set up to the way you're going to do it. The access isn't going to be efficient. I've never, it's astonishing when you buy data, how dirty it often is, and how disorganized it often is. And or they'll do things like, revise data without telling you, or change the format of things without telling you. And the problem, again, part of the problem is, again, a lot of the work that's done in markets is very short term. So, after a couple of years, people think that nobody's going to want the data. We wanted data going back as far as we could when we were at Renaissance, right? So, but nowadays, even today, we should know better. Most of these things are organized with the idea of you have somebody sitting at a screen who's going to kind of call up the data and look at something and maybe go back a few years, and that's about it. And so if you really want to do sort of a real sort of quant analysis and or build some real high frequency trading stuff that's going to run off the data, you're not going to be able to use those tools. You have to sort of build your own. And part of that's a real problem. And again, it's just because, frankly, very few people recognize how important building that data structure, those data structures are, so that you can efficiently go in and pull like an intraday time series of prices and trades out, very quickly, get it into your code in a standardized way that everybody knows what it looks like, process it, efficiently. That kind of analysis is if without that kind of standardization on the data side, like I said, it basically doubles the time it takes to get anything done. So, it's unfortunate, but I don't know of anybody out there who has a suitable infrastructure for sale that you can just go in, use that, and you don't have to worry about data because he's done everything for you. I haven't seen it yet, so.
Right. So actually right now what you're doing at FQS, so the Frey Multi-Strategy Fund, you employ a quantitative approach to investment. And unlike most quants, instead of directly investing into asset classes like equities, you invest in managers instead. So can you share a little bit more about your fund's investment process and the quantitative strategies that you adopt at FQS?
Right, sure. Well, one of the things that, again, consistent with what, I said, basically trying to push the envelope and do, a lot of stuff that nowadays people are calling machine learning or AI, these things have been around for a long time. And we used a lot of this stuff in the 90s. We had people who had worked in DARPA for doing code breaking. Other people worked for IBM doing translation and speech recognition. So and a lot of these things generalize very well to work to stuff we were doing in finance. So one of the things that we do in FQS is that we use, basically, if you want to call it AI ML, to develop it's not a traditional factor model, but let's call it in effect a factor model that will apply not only to ordinary investments, but also to hedge fund strategies. We sort of extend it to include hedge fund strategies. And so our analysis of hedge funds is first that it's got to look good to the model, because at some point is that we don't really understand it if we can't model it properly. And so things that, because, and what we find, for example, very interestingly, is that a lot of, and this has been true for several years now, it's, a lot of funds that seem like they have a very high rate of return are in fact driven mainly by market effects. They're just, there's not really any alpha in them, So we look for funds that have genuine alpha that generally are not correlated to the market. And that's our first gate. Now, the second stage of that is to sort of look at, the operation, so an operational due diligence, and make sure the legal documents look okay and everything else. But, the first gate they have to pass through is they have to pass through the model. And, we sort of restrict ourselves to things where we understand to the extent that we can model it effectively. And then if it looks good in that context, then we do the other work. But that other work is basically to see, is there anything bad that will disqualify them, which does happen. Sometimes you'll have people with crazy relationships or crazy terms in their documents and that sort of thing. But that's sort of the process. It's not, and so, when we have a pipeline process where funds come in and they go through a certain workflow, and as they go through the workflow, they're monitored. And then if they get to the point where they're approved for investment, then we have allocation meetings periodically where we just, from the set of funds that we've sort of qualified, what are we going to add stuff, do stuff, change the portfolio? And so it's a kind of a, fairly now well-organized process. But again, we're, I'm not, unfortunately, a lot of people are charging 2 and 20 funds, which are basically just, the S&P plus maybe a tiny little bit of alpha, or worse, mostly S&P and negative alpha. So I think that it's our process is really focused on using our models to figure out who's actually producing what you might think of as truly, true alpha, true above the system, above, sort of cleaning out all the systematic returns of stuff that they're attached to, and actually looking at what value added the manager is adding onto this.
Given that most quantitative funds mostly hire professionals with PhDs in their respective fields, what advice do you have for students who are interested in pursuing a career, as a quant? Should they just go out right now, or?
Well, I don't know. I mean, I think a lot. I mean, to a certain extent, it's opportunistic. You have to look at what jobs are out there at the moment. One of the things, though, I will say is that you can't do any of this work without being a pretty good programmer. So people should, to go in and say, look, I know all of this math, and that's kind of nice, but typically they're going to want you to program, and I don't mean that like an application programmer. You don't want that kind of job, but basically, if you're the guy who's sort of developing a strategy or trying to improve a strategy, you're going to have to run tests and do studies, and so you have to program that stuff yourself. I know cases where basically they'll put a guy in and have a programmer, and he talks to the programmer, and the programmer implements stuff. On the research phase, that doesn't work. Maybe for at the stage where you're actually putting it into practice, maybe, but on the research phase, that person has to be able to go down and program this stuff themselves. So being a good programmer, and also, I think what you really want to bring across, let's say, in an interview, is that it's not just that you have mathematical skills, but you've actually used those skills in some sort of real world context. At Renaissance, we'd sometimes find somebody, like, for example, you'd find somebody who would say, I had this, theory about how, the frequency of earthquakes and this kind of thing. I mean, I just remember this case where this person was talking about how he felt, that based on his study of geology and the earthquakes should follow this pattern and this kind of thing. And we asked him, I said, well, how well did it? So he had this big theoretical model. He had stuff published and stuff, and he was a really strong maths background. Then we said, well, how did it actually predict earthquakes? The guy goes, gee, I don't know. Well, we didn't hire him, because what good is what good is a great model? I mean, there's a lot of great models that don't fit the data, so there's a lot of interesting mathematics that maybe apply to the problem we're dealing with. So that kind of thing is that you want to come across as somebody who can actually solve problems, and that's important. And then again, that's a key thing.
Yep. So aside from learning coding and being a problem solver, so do you think there is any undervalued life experience you think university students do not give enough weight to?
Again, it's hard to tell. That's hard to tell. I mean, because a lot's going to depend on the specific job, and also to some degree to the person interviewing you as to what they're looking for. Some people, I know some people who, insist on hiring people for certain jobs. They just want people with military experience. Why? I don't know, but they do. There's other people will, they'll look for things back in a person's background, to these little indicators that to them mean something. I don't know. I mean, we tended not to do that. We tended to, we look for people who were problem solvers, who could, basically with strong mathematical skills, but who had used those skills to solve real data-driven problems. And, that was our focus. As far as, beyond that, we didn't care anything about anything else. In terms of students going in, unfortunately, you are at the vagaries of the hirees' prejudices and biases about things that, that, oh, this person didn't have this experience. And I don't think, and I want somebody with that experience. You can't, that just is the way the world is. And so what I would go in is just try to make yourself as strong as you can. Make sure you understand what the job is you're applying for, know as much about the company as possible. And, that's going to improve your odds. And that's all the advice I can give. Yeah.
Yes, so we have one last minute. We have 4 rapid fire questions that you can answer with just maybe a word or quote. Yeah. So if you're 20 again, would you have done the same things that you did?
I think I would. Yeah. Yeah.
Okay. One word to describe, or phrase to describe James Simmons.
He's an honorable man. That's what not smart. He's smart. He's really smart. But what really distinguishes him is that he's a genuinely honorable guy. I mean, we would have very deep discussions about, things we would do. And when we had, at the time, eventually we ended up without investors because we took everything over ourselves. But when we were doing this, very often we had a lot of discussions about, are we doing, so we wanted to make sure that if we do this, are we being fair to our investors? What are we doing? This kind of thing. And, that was a real, that kind of, when somebody's, has that, that creates an atmosphere in a firm, right? And so this, this sort of like cutthroat attitude was not one that was accepted at Renaissance.
What's the best advice you have been given?
Oh, what's the best advice? Well, look, I think, if you're in a job, right? There's an old saying, the Roman soldier used to be paid in salt. That's where we get the word salary from, because it's you're paid in salt. So it's called taking the man's salt. So if you take the man's salt, do the job. Right. So if you're in a place, I don't care if, maybe it's not where you want to be right now. Maybe you want to do something, but do the job, because whatever else is going on, not doing the job is going to hurt you and going to hurt other people. Just be an honorable, like I say, be an honorable person. If you're there taking a salary, do the job and take that job seriously.
Okay. And finally, the sciences or the humanities?
Oh, both. I mean, but like I said, when you look at, as I said, you need to be a historian. I meant that seriously. And so history is not just certainly not a quantitative discipline. It behooves you to understand, when you look back, to sort of have some historical perspective. It's very, very important. And it's important to understand some of the sociological aspects of what you're doing, because they help explain and help you understand what's happening in markets. So, I think that's, it's not one versus the other. I mean, obviously now I've specialized in the quantitative side of things. So I wouldn't consider myself a historian or a sociologist, but certainly I've read a lot in those areas because I think it's helped me think these things through. So it's not an either or thing, I don't think.
Thank you so much for your time, Dr. Frey, and we wish you all the best.
Yeah, thank you. And everybody, thank you for everything, and good luck, everybody.